him and his constituents and holdings. So I don't know how well that's going to turn out, giving him that kind of control over the Treasury Department payment system. And I don't know how he's going to influx and try to influence his holdings with Tesla to be part of that, and SpaceX. I'm pretty sure he's going to find some ways to shuffle around funding so his programs end up with a little more funding than they probably would have originally. But that's one of the perks you get for being, I guess, the right hand man to the president right now, and having your own department of was it Department of Government Efficiency, the Doge department. So this is what you get with that kind of stuff.
I think it's a double-edged sword. It can be a positive thing, but I think it's going to be negative on the grand scheme of things. So now you can control the influx of who is actually getting funded or defunded, right? You might have a bias towards a certain company or a certain individual that you had over the years, so you might want to defund their department or the money that actually goes to that department. So this is a crazy thing for him to have access to pretty much every United States citizen records and funds and things like that. So I don't like it. Now, DeepSeek, everybody should have an opinion on this. Wow. This is a technology that's similar to ChatGPT. We know what happened, ladies and gentlemen. It crashed, it pretty much crashed the market when it came out. Everything actually pretty much got what? Killed. So can anybody elaborate on what do you guys think this means for us as an economy, as a tech-heavy society in America moving forward? What do you guys think DeepSeek is going to do? What do you guys think? Anybody, what do you guys think? Y'all think it's going to be positive, or you guys think it was negative? I think that it was a must. We needed another country and another software to actually come out to make us realize that, hey, we was getting what? We was getting duped, right? So they came out with something that was pretty much similar, and it was free. Don't get me wrong, China was getting access to our information, but at the end of the day, these apps inside of America is getting access to our information too, so we got to think about it on the grand scheme of things. So my thing is, I think this was just a prop to let people know what's to come when it comes to the tech sector. So my thing is keep your eyes on it. They do want to drop the tech sector down so they can go in and buy more. Now, let's talk about ARK Investment. Can anybody tell me who's one of the biggest investors on Wall Street that owns ARK Investment? This is news, ladies and gentlemen. This is why this is very important. Who owns ARK Investment? ARKK. Can anybody tell me? She's a female. She's on Wall Street. Who owns it? What is her name?
She's one of my favorite on Wall
One of
Street.
my favorite. One of my favorite on Wall Street as well. Can anybody tell me? Kathy Wood. So Kathy Wood, ARKK have had a return this year so far 10.75% as of January 31st. She's killing the S&P and the NASDAQ, right? So I want you guys to pay close attention on what she's selling and what she's buying. Because my thing is she always foresee the future. I mean, she might get out of trades a little bit too early, but that's part of the game. We're not going to always stay in trades for the duration and then continue to keep on accelerating. We have to take profit at some point.
Right.
Now, Johnson & Johnson is going to be acquiring a cell therapy company. I want you guys to think about this. When it comes to Johnson & Johnson acquiring a company, they feel like, hey, we can be this company become beneficial to our portfolio. So I want you guys to lock in on where Johnson & Johnson will head over the next 3 quarters, because they're going to be closing this deal out before the year is over. So the next 3 quarters is very key. So Johnson & Johnson can actually continue to keep on rising. But I like the acquisition. Now, when it comes to EV, Honda has a new production resolution beginning with a $1 billion investment in Ohio. I want you guys to give a round of applause to America and the state of Ohio, because we are bringing EV to the mainstream. Because, China is running the game. Elon Musk with Tesla is one of the most recognized brands, but that don't mean it's the best EV car company in the world. So I want to give a round of applause to the United States. They are bringing EV home. Not saying that EV is the best form of transportation, but it's an option, right? So when it's an option, ladies and gentlemen, we want to understand who's controlling these options. Now, think about what I'm about to tell you. With these tariffs, ladies and gentlemen, it's going to leave large corporations and companies in the United States is going to be affected. You got General Motors, Mattel, you got other brands, Celtic brand, we got food, we got Nike that's going to be interrupted. Can anybody tell me why is Nike is going to be interrupted by tariffs? Why Nike is going to be interrupted? Can anybody explain to me?
They have like raw materials they produce in China.
Raw material, Nike, because of the cost of the product at Nike, right? China makes Nike what? Products, right? Not just shoes, it makes apparel, and it makes multiple things. Now, I want you guys to think about what I'm about to tell you. Apple sales was down in China. China is one of the biggest producers of goods in the world, right? So if we're going to be putting tariffs on China, what is it going to do for Apple? It's not going to be very good for Apple, right? So that's why Apple has been transitioning and building up their brand inside of India, because India also have a billion people in their population as well. So China and Apple don't have the best relationship, so that's why Apple has been pivoting over the last couple of years to actually build up an infrastructure inside China, inside of India. Now, Google is offering voluntary buyouts from the hardware platform team. I want you guys to think about this. So if Google is giving voluntary payout, what does this mean for the future? That means Google is going to be hiring more what? Robots, right? That they own. So guess what? They're going to be able to keep the money internally. So the news is shaping out to be very important as we move forward. Now, who shop on Shein's? Who have kids, who have family members that shop on Shein? This is important. Shein is going public in London. So you're going to be able to buy this company from a stock exchange. So Shein is going public, ladies and gentlemen. This is very important. So with this news, ladies and gentlemen, I'm feeling a little bit bearish this week, right? With all these tariffs going on, not just the United States, but abroad, I'm feeling very bearish, right? If they don't figure this thing out, ladies and gentlemen, we can see a 5 to 7, maybe a 10% correction in the market, and we want to be able to take advantage of it. And I will tell you guys this: if you have $5,000 and we go between a 10% correction, I guarantee your $5,000 can turn into $250,000.
Oh, well, for put correction, oh yeah, that's how you gotta take advantage. The short-term pullbacks have massive gain opportunities in them, and that's where the short sellers make a lot of their money, which is why people even take on the profession of short selling. You understand? Because you may take a long time to hit on your short position, but short positions, when they do come around, they are very lucrative. So people tend to make a lot of money on short positions when they do come around. And that's why a lot of the times when you see a pullback in the market, you'll see it is short and violent. Even when you look at recessions, when you look at a recession, it's probably the longest version of a pullback you get, right? But when you look at it on a large scale and you stretch that recession out, it's still a very small period of time compared to how long the stock market has been on the uptrend. So you gotta always understand that these short pullbacks, even a recession, in the big scheme of things, is really pretty much is a short-lived time. And it can wipe a lot of people out if you're not careful, especially if you're trying to do high-level frequency trading and you're not ready for a bearish market and you're trying to time the reversal back to the upside and you keep getting caught in those pull downs. That could wipe you out really quickly. So a lot of people get nervous in these times. A lot of people start selling their long-term shares instead of dollar cost averaging into their positions to make them stronger positions on that rebound, which is what I really suggest a lot of people look for in these times, especially if you're not an avid daily trader, if you're not someone who's on the markets and watching the news every day, and you're kind of just taking news or getting information from me and Cardav as we putting it out on the Discord. I suggest you stick with your long-term portfolio and look at the price points that we put out there as far as good buying opportunities and use those as your dollar cost average endpoints and just buy more shares there. And when the market resumes its up rally, then you could jump into the option trading again, because now we're on a general upswing and you won't get caught in such a heavy pullback so easily.
I like that. That's a great explanation, ladies and gentlemen. Remember, the market has been going in the uptrend for over 50 years, right? So in a little glimpse, when we do have recessions, we have things like pandemic, like COVID when it happened. That's a small little piece of the market, right? Not saying that it's not an opportunity to make money if you're a trader of futures, you're a trader of commodities, you're a trader of options, right? Or you just short selling shares. But this is your opportunity to buy loans, so you're buying at a quality price, and as we continue to extend that, keep going to the upside over years, you'll get a better return on long term than on options, right? Don't believe me, the video was $3 a share. Y'all see what the video is at now.
Yep.
1,000%, 2,000, 3,000% return, depends on where you got in as an investor. Now, let's talk about earnings, ladies and gentlemen. This week we got massive earnings. We're going to focus on a few of them that make sense. I'm going to take Monday and Tuesday earnings, and then Mike is going to take Wednesday through Friday.
Okay.
So Monday, after the bell, this is very important for you guys to lock in to what I'm going to tell you. We got PLATR, right? This is very important to lock in, and we got NXPI, lock in on that. But now, my favorite trade is going to be on Tuesday. I do like PayPal, and I do like Spotify. I do like Pepsi before the bell. Now, we do have Ferrari race, and I want to talk about this. listen to this. Watch this, y'all. Just because you can't afford a Ferrari, right? Buy the stock because guess what? Wealthy and rich people is gonna buy what?
Ferraris.
As they buy Ferrari, the stock is gonna increase in volume. It's gonna make you money over the long period of time. Now, Pfizer is a wild card. Because we know that Pfizer, what they offer, right, and what they don't offer, right? But my whole thing is, when it comes to long term, I won't own Pfizer, but I would trade it on a short period of time, and I will swing it for quarterly contract. If the bird flu continue to keep on outbreaking in America and abroad, Pfizer is one of the main companies to keep your eyes on to make a vaccine. Now, Tuesday after the bell, ladies and gentlemen, this is going to be a deciding factor on how Wednesday actually shape out in the morning. We got AMD, and we got Google, we got Snap, and we got Chipotle, and we got Infast after the bell. But I want to lock in on AMD and Google. If AMD beats earnings, ladies and gentlemen, that's going to send the chip sector to the upper room, right? So we can play things like MU, we can play things like Intel, we can play things like NVIDIA, we can play TSM. So my thing is, please pay close attention to what happens with AMD and Google. Now, Mike, take it away for Wednesday through Friday and what you think is important.
So from Wednesday through Friday, man, that Tuesday is going to be a hot day. Google and AMD, I can't wait for that Tuesday. It's going to be beautiful. But as far as the rest of the week, we got Wednesday, Uber. Uber is actually, not going to lie, one of the long-term companies that I do like as far as their positioning in the delivery industry. People are looking at Uber as only pickup, ride-share kind of service, but Uber is now into grocery delivery. Uber is going to get into freight delivery, and Uber is going to get into air delivery as well. So you're going to start hearing about Uber flights, Uber planes doing deliveries for goods and services, and they're going to expand themselves in that kind of way. So they're going to be a logistical monster going forward. Then you have Walt Disney coming in on Wednesday. Disney has suffered a pretty big pullback in the last, I say over the last year. They had a nice little struggle. But if you all remember, Disney had that big partnership with Disney did a big partnership with, I believe it was, who was I think it was not Meta, Apple. They had an Apple partnership with the Apple glasses, where they were trying to incorporate a lot of Disney content into the Apple Vision Pros, or similar to like the Meta Quest, the glasses. So Disney has a partnership with that. I don't think that is going away. I do think it's been tampered down. They were a little far ahead of the curve. So I'm not too excited about Disney. Then we have ARM. ARM Holdings has been really hot lately. If you guys have been watching the ticker symbols, as a lot of the chip sector has been going up, ARM Holdings has been one of the companies that's been benefiting off of that as well. Ford doesn't excite me too much. Eli Lilly on Thursday, that's a big one. Eli Lilly is in healthcare. For all those that are into trading and understanding the healthcare sector, Eli Lilly is a behemoth of a company in healthcare. So their reports coming out Thursday is going to shift the market as far as the SPY. And mostly the SPY. It's going to shift the SPY more than anything. And then we have Amazon after close. That's a big one. And then we have Microchip. But really, Amazon and Eli Lilly is what I will focus on for Thursday and Friday. Is nothing really too heavy coming in on Friday. They're giving you kind of a day to recover and catch yourself after everything that's reported throughout the week. And by Friday, we should kind of get a decent pulse on the market on which direction it's choosing to go after these earnings reports. So a lot of the times I tell people, if you're not really disciplined with your take profit and stop losses, don't trade through earnings. Wait until after earnings and see which way the market is trending, and trying to put your trade in to follow that trend on the market post earnings.
Right. And I want to dial it back a little bit because I did miss a few things on Tuesday. Is this very important from all my video game players? EA Electronics that makes video games, they do report after the bill. So that's going to be very important. And then, Mike, you missed one important one that the kids love: Roblox.
Oh, I was going to say Roblox. Yes, Roblox. Roblox is one of those companies that is on a bounce back. Last time I looked at the chart, I want to pull up the Roblox chart really quick. Let me look at that real quick and look at where they are right now. As far as monthly, they're on a very nice recovery. If you're looking at Roblox on the monthly chart, they're actually reaching consolidation that they hit back in May of 2021 through November of 2021. They're actually getting to the bottom of that consolidation zone. So if we get above for the price of after this earnings, if Roblox comes out of this earnings over $80, you can expect a pretty strong push from them because that pushed them above their sell block, a monthly sell resistance at that. So when you break a monthly resistance, you can expect a really, really big push off of that break. So keep an eye out for Roblox, $80. That's a big one right there. Good call out, man.
And I like it. And another one, which is one of my favorite, I always traded leading up into earnings and to earnings as well as Pinterest. Ladies and gentlemen, we know this is a social media platform as well. It doesn't get a lot of praise and a lot of hoop and holler like IG and TikTok, but my thing is a beautiful site if you guys are looking to do things, especially when it comes to actually making healthy food, making food choices, not just for yourself and your family. I like it. And on Friday, if you guys are into anything that deals with medical marijuana, we got CGC. So my thing is pay close attention to that and lock in on that. But this week, this is earnings, ladies and gentlemen, so it's going to be a nice week. We do have some heavy hitters. But like I said, I'm with Mike. I agree. Tuesday is going to actually determine a lot as we move forward through the rest of the week because we do have Amazon Alphabet that is actually going to be reporting. So we'll see how it actually shapes up leading to the rest of the week. Now, let's get into some meat and potatoes, Mike. Let's go. Me and Mike is going to go back and forth. We like to tag team, ladies and gentlemen, because both of us is full of knowledge and we want to share our platform to the world. So long-term investment. What is long-term investing, right? So when you guys think about a long-term investment, it's a strategy of holding an investment, right? I don't care if it's real estate, right? I don't care if it's bonds. I don't care if it's stocks, right? I don't care if it's any other form of investment that you like. Now, holding commodities, gold, and things like that. So now, let's talk about this, Mike. What do long-term investment mean to you? And how long have you been into long-term investment? What would be your advice to somebody that's trying to get started in long-term investment?
For me, long-term investing is something that is essential for anybody that's really looking to be a true investor in the market. A lot of people make a lot of money scalping and shorting trades, but long-term investing is where the real wealth is generated. So you're looking at, when I think about long-term investing, I think of holding something over 3 to 5 years. When I say 3 to 5 years, and when you starting off now, you got an investment now, you're looking at something you're buying today, 3 to 5 years is kind of when you get to the point where you always want to get to a point where you take some profit. You never want to be in long-term investment forever and never withdrawing any profit off of it, unless you're going to use a strategy in which you're building up an investment and you're going ahead and borrowing against it, which is another strategy people use with long-term investing, which is why I like it, because it gives you a versatile way to access that liquid cash. The more long-term solid investments you have, the more likely the bank is going to allow you to borrow against your portfolio and account, especially if those are in blue chip companies that have strong support on them that don't tend to pull back or have high levels of volatility. Right now, you may see a lot of people getting into long-term investing with crypto. So a lot of people are trying to position themselves, even the big boys like BlackRock, the banks, and the government is trying to figure out how they're going to position themselves in long-term in the Bitcoin crypto holding industry. So you'll see a lot of people trying to position themselves now for something that they know they're going to profit on 5 to 10 years from now. It's not about profiting off of this right now. Like, I don't know if anybody's familiar with MicroStrategy. MicroStrategy is big on their Bitcoin holdings. They're not looking for benefit off of it now, which is why you'll see them still buying it at $95,000 or $100,000, still buying large amounts, because in 3 to 5 years is really what they're looking for. So this is where the wealth is really built in investing, long term.
And it takes time. You got to think about long term like a child, ladies and gentlemen, especially from a woman's point of view. I have 7 kids myself, but from a woman's point of view, my wife always explains to me, a child grows, right? It takes 9 months on the average for a woman to have a baby. They have them a little bit earlier, but then you see a child go through crawling, you see a child go through walking, you see a child go through running. Now they're in school, now they're in middle school, high school. So that's what investment is, ladies and gentlemen. Is a process, right? It's called growth. You have to allow it to grow. Because me personally, I was born in '88, and then when I go look at the Apple stock that was $2 or $3 in 1988, it makes me go, wow, what was my family and their friends was thinking? Why did they not do any investment back then? Everybody would be millionaires, right? Yeah. Now, a few things that I want to talk about on side is long term, and then Mike, we're going to piggyback and forth. All these are great investment, ladies and gentlemen, but I can tell you this: real estate is a harder investment than stocks. Right? Because if you're buying real estate, especially if you're getting funded from the government, you don't have your own source of funding, it's going to be a little bit harder. But anybody can buy stocks, right? I don't care if it's penny stocks. I don't care if it's cheap stocks, 15, $30, $40 stocks, you have an opportunity to invest every time you get paid from your 9 to 5. Now, anybody can buy bonds as well, right? So my thing is, sort of on the cheaper end, stocks, bonds is a little bit more cheaper than real estate. I'm not telling you not to get into real estate, but do some investment in stocks and bonds and see how you feel emotionally. Do you have too much attachment to money? And then now you can do real estate investment outside of your personal investment in real estate for your house, for you and your family. So I believe the stock market still got a large potential to actually grow. My trajectory on 2030 S&P 500 is at 7,000, 7,200, right? So my thing, we can super exceed that, or my thing is we can go down to my lower trajectory of 4,800. We can have a massive pullback, we can have a recession, but my thing is long-term pays, ladies and gentlemen. So I want to talk about something else on the next slide, me and Mike, the key features of long-term investment, including what? Let's talk, Mike, compounding. Can you explain to the people what is compounding?
Compounding is they call it the fifth wonder of the world because of how fast it tends to grow whatever you apply compounding to. Right now we're talking about investing in your portfolio. So compounding returns are the earnings that you have reinvested to generate additional earnings over time. So when I say a long-term investor, when you get to that 3 to 5 year point, sometimes people have dividend payments coming from their long-term investments, and they're taking the dividend payments instead of reinvesting them back into the company. When you look at how much money you would make by reinvesting the dividends versus taking them out as profit, or taking your profit out and keeping things reinvested, you'll see how much more rapidly your portfolio will grow within a span of 3 to 5 years versus somebody who is constantly taking profit every time they see a profit on an investment or a trade that they have, instead of reinvesting that profit into the next investment or the next position that they're doing. So that's really about compounding. That's all compounding is. So you got, in crypto, you have people who are staking, right? And you stake a coin, and based on that, every month you get a certain amount of money in return, similar to dividends. You could put it back in, or you could take it out and spend it however you want. Putting it back in is going to grow your position 10 times faster than you would by just leaving it in there and letting it grow independently. So compounding is the fifth wonder of the world.
All right, I like it. To actually follow up on the compounding, I'm going to give you guys a layman's term. Think about this. A lot of us actually work out. We go to the gym, right? We know that, hey, I'm a little bit weak, right? But if you continue to keep on going to the gym, now your muscles is compounding, right? So now you're inside of a good regimen. So that's the stock market. The more you put in, the more it builds, right? But you have to give it time to actually evolve. Now, investing long-term is less stress, right? Because you're not dealing with it on a daily basis. So that's why I like to invest long-term. It doesn't stress me out, right? With them like doing day trades and things like that. So long-term doesn't stress me out. And it's tax efficient, ladies and gentlemen. Long-term capital gain typically have lower tax return than short-term. So option trading, we pay higher tax return, right? Long-term, we pay lower tax return. So there's multiple ways we can get into that, but we'll cover that now. Me and Mike, we like to focus solely on fundamentals first, and then we focus on technicals later, because fundamentals move the market, not the candlesticks. So my thing is, understanding what the company have going on long term would actually make you a better trader and a better investment. Now, can you explain to the people why you like fundamentals over technicals when you first start reading into a company?
Yeah, especially when you're investing in a company long term. Technicals is more for somebody doing weekly or trades in the options market. You could use technicals to help guide you in those positions. But when you're looking for a long-term investment and you're doing research on the company, you got to look at their fundamentals. You got to look at what their earnings reports were. Are they growing in earnings? You have to look at the assets they have on hand versus the liabilities they have on hand. And that's really going through their financial reports and looking at what they have as far as public information available. You'll find this on any trading app that you use, E-Trade, TradingView, Robinhood. When you click on the company, they're going to give you a breakdown of the company, and then you could go deeper into this financials. And when you do that, that's when you're going to get a real understanding of where the company is, where it has potential to go, and where it is, where it has potential to pull back to if it does. So a lot of people look at fundamentals on a company and they'll say, you heard of price to earnings ratio. And sometimes the PE on a company will be 100 times, right? So that means the current price it's trading at is 100 times more than what is actually valued at on paper. And that's where fundamentals come in. It's about that on paper value. How much are you worth actually on the books? Not how much we're projecting you're going to be worth in 5 years. How much are you worth right now with what all the assets and everything you own, all the debt and all the bills that you have, all the employees you got to pay. How much are you worth right now? And that gives you a really clear picture of where the company is. And then you got to do your research, tracing it back and looking at it going forward, and to see where you may see this going and see if that's a good investment for you or not, for a long term at least.
I like that. I like that. So that approach is very important, ladies and gentlemen, not to just you, but your kids and your grandkids. My whole thing, we want to invest now so our kids and our grandkids don't have a hard time investing in the future, because the scope of investing is changing. You have the top 10% in the investment in America owns 90% of the stock market. So at this pace, they're going to own 92, 93, 94, 95. Then eventually you're not going to have an opportunity to buy any stocks in the market, right? So take advantage of this opportunity while we have free trade, ladies and gentlemen, get into these investments. Now, we got a few more slides before we get into the big boy. Now, when starting to invest for long term, many people make several of the common mistakes. I want to talk about the first three. Mike will talk about the next three. Lack of research, right? You know how people in the barber say, oh, this company is going to do well. Okay, it can do well in the moment, but is it going to continue to keep on do well over a long period of time? So that's where research coming in. A lot of us lack the research because guess what? We don't understand that there's sources out here that can help. We're not talking about this, hey, ChatGPT, can you tell me about this company? No, you want to be able to read into this company for yourself, like you said, the F-13 filing reports, right? Because this is going to give you the ins and outs of the company, where the revenue is coming from, right? How much money is spent on employment, how much money is spent on actually acquiring other companies, acquisition. Now, time in the market. Listen, ladies and gentlemen, you keep thinking you can time the market's going to time you out of it. Right? And that's a fact. So my thing, you say, oh, I'm going to time the market. No. This is by quality companies, quality stocks at quality prices, and allow the rest to do what it's going to do, right? Because if you keep saying I'm going to time the market, oh, it's going to bottom out, and then SPX and SPY continue to keep on going on the uptrend, you done missed the quality price. Now is up $100, $250 since the pandemic. So now you missed out because you was going to time it about the market's going to keep dropping. Okay, keep waiting on the market to drop, and the market will continue to keep on leaving without you. Now, emotional investing. Please, ladies and gentlemen, you have to get away from your emotion. You cannot have an emotional attachment to money that you're looking to make money 5, 10, or 15 years from now. You have to play the long game, ladies and gentlemen. If anybody ever plays sports, you need to understand that in the first quarter, you can be up by 20 in an NBA game and lose by 20. You got that?
Yeah.
You can be up by 20 in the first quarter and lose by 20, right? So please, ladies and gentlemen, control your emotions. Go for it, Mike.
All right, and then the next piece I want to talk about, we're going to talk about diversification. Diversification is something that people tend to want to push to the side because you want to get into one particular industry or one particular company because you're hearing news about it. But ignoring diversification could really damage your portfolio in the long run, because we're long-term investors here. We're not looking to scalp trade. We're not looking to scalp invest. We've got to have a long-term mindset. So with a long-term mindset, what you got going on is you got to understand that majority of companies are going to go through some version of a pullback. Not everyone is going to be industry widespread or all through the chip industry like we're seeing right now, because the DeepSeek is not always going to hit the entire industry. You may have picked that one company that maybe has bad news on its CEO, right? And it causes a pullback in your stock, in your holdings, but the whole sector as a whole is still doing good. So now you're looking like, damn, man, I wish I knew chips were going to do good, but I just picked the wrong company. You know why? Because you're not diversified. Instead of just picking one company, how about picking an ETF that represents the whole chip industry? Or if you're not that studied, go ahead and just pick a S&P 500 or the NASDAQ, because these ETFs keep a rotation of companies coming in and out. As long as they're performing up to par, they can stay in the S&P. If they're not performing up to par and growing, the S&P will cut them. So they're doing the research and work for you, essentially. And that's a diversification in itself. Now, when you're a more advanced investor, then your diversification could come through you picking individual stocks or industries that you want exposure to. But at first, when you're just starting off, keep it simple with ETFs that are diversified in the sectors or inside the whole market the way you want it to be. And every ETF you could find, I got a site that I put on my Discord that breaks down all the ETFs for you. It tells you exactly what companies they're holding in the ETF, what percentage of the holding is that company in the ETF, etc. Neglecting cost and fees. So people that are heavy investors and traders who do frequent trading are getting hit with constant fees. Every time you do a trade on one of these exchanges, they're charging you a fee. And that's how a lot of these exchanges like E-Trade, Robinhood, this is how they make their money. This is how they survive as a company. They're not making money off of you making money on your trade, but they're making money off of you every time you do trade. And that for them is risk free because it doesn't matter if you took a loss or a win. When that transaction goes through, they're getting a percentage. They're going to get their payment, whether it's 1 or 2%, whatever the transaction cost is. They're going to get that payment. So you got to pay attention to those and pay attention to how compounding that, like we were talking about earlier, compounding gains, you could compound losses through stuff like fees and costs that you're not paying attention to. And always set realistic expectations for yourself. Look at the standards of the market and the industry. There's a standard that the S&P goes up every year. There's a certain percentage that the NASDAQ goes up, the Dow Jones. When you look at these industry standards and you say, if these are the industry standards, and you look at a BlackRock and then you look at a Berkshire Hathaway, if these guys average this percentage gain on a year and they're deep research, deep study, they have whole teams of people working for them, what makes me think that I am going to come in here and triple that average on a year? You know, when they average 10%, what makes me think I'm going to average a 40%, 30% return on my year on my overall portfolio? That's thinking outside. You're not thinking realistically at that point. That's when you get caught up in the short game and all the things you see with option trades and you see people making 1,000% here, 500%. You're like, well, shit, if you could do that with a trade, I could make my account grow 200% in a year. That shouldn't be that hard. No, you got to think about this. These are usually small amounts of money people using from their portfolio to make these high risk trades. You'll never put your whole portfolio in a trade that risky and get a 200% return and get out on time, you know? And even if you do that, if that's your strategy, best believe at some point throughout the year, the market will smack you and take all your money away. So,
right.
You know, don't set unrealistic expectations. Whatever the industry standards are, keep your standards around the same, maybe a little bit higher because you want to push yourself, but don't set it 2-3 times higher than what the industry standard is.
Right, because now you're moving the goalpost, right? Too far out, right? So if you even get a little move halfway, you say that's not enough, so you're not taking profit, right? So you say, I want to be able to go 50%, but if you do 25% return on your whole portfolio in 1 year, bravo. That's a lot of money.
That's a beautiful year.
80% of the hedge funds lose every year. They don't beat the market, right? And they plan with hundreds of millions and billions of dollars.
Yeah.
So my thing is, with your port, you want to make sure you protect your port, right? If you got $100,000 Roth account and you grew at 10% a year for 10 years, you done doubled your money.
Yep.
Right? So it's all about growth. So now your retirement is sitting good. You're not being too aggressive, right? So you don't want to be too aggressive. Now, a few more slides. Let's talk about stock investment. I want you guys to understand that when you're buying a stock, it's ownership, ladies and gentlemen. You own a portion of the company, right? I don't care what type of stock. You can do a common stock, which will provide voting right, or you can do a preferred stock, which typically does not have voting right. Now, I want you guys to understand, Google have two stocks. One is what?
Preferred.
Preferred, and one is common. So one is stocks you own with Google. You don't have any voting rights, right? So my thing is that's very important to understand which companies you're invested in and why you're investing in that company. Now, we talked about potential dividends. On a later date, we'll cover more into dividends. I just wanted to put that. Now, I want to show you guys the top dividend holders inside S&P 500 that I love and that I like. We're going to go over a few of them. We got MO. We got CC Crown Hold Council. We got Verizon. If you guys own a Verizon phone, ladies and gentlemen, you should be buying Verizon stocks every month because you're paying a phone bill to them. So if they're going to provide you a service, why not get paid off that service on 5 and 10 and 15 years from now? All the cell phone bills that you done paid with Verizon is free because you done bought the stock and now your return have what? Compound. Mike just gave y'all guys a gem. It compound. Y'all understand? You reinvested your dividends. So now your phone bills is free because guess what? You bought $1,000, $2,000, $3,000, $4,000 worth of stock in 10 years. You got a 300% return. So now all your phone bills is free. Now, realty owned, and then we got UPS. We know that we got those people that show up to our house in a brown truck, the brown outfit. So my thing is, why not make money from them, ladies and gentlemen? Now, let's cap it off. Mike, let's get it. What is liquidity and what does it mean to you?
So liquidity, and let me read the definition and I'll tell you what it means to me. Stock market liquidity is a measure of how easily and quickly a stock can be sold for cash without significantly affecting its price. High liquidity means there's high demand and supply for an asset. It's easy for buyers to find sellers and vice versa. So you usually see high liquidity on companies that have a lot of influx of volume on them as well. So you'll get high liquidity along with volume. And then it says transactions can be completed quickly even when stock values are dropping. The bid and ask price are close together. And that's what you want to look for when you're doing these option trades. You don't want to see the ask price. And if you didn't watch the videos or you weren't here, make sure you go back and check out the option class that we did, part 1 and part 2. We talk about this. You want to make sure that your bid and ask price are close together. So if the ask is $100 for the contract, you want the bid to be no further than probably like $90, $95. If you start seeing bids more than $10 in spread, or spreads by more than $10 or more, then that's a very, very wide spread. That means there's not a lot of liquidity there in the market. It means there's not a lot of buyers and sellers on that particular contract. So liquid is what we're talking about when we talk about cash. So that's really all we're talking about, liquidity. We're talking about cash. How much cash is flowing in and out of this company at the given time. The more cash is flowing, the tighter the bid is going to be. The less cash is flowing, the wider the bid spread is going to be on a lot of those companies. So maybe a big name company that you like and you're familiar with, but when you go look at the contracts, they have these high spreads on them. That means it's not very liquid company. And believe it or not, there's some big companies out there that are trading in the stock market that are not very liquid at all. So you got to be careful. Just because it's a name that you're familiar with does not mean that it has high liquidity on it.
Right. In that instant, I try to tell traders, Mike, and you might agree with this, if you really like it, just trade the shares.
Right. Right.
Because now you're saving yourself time and effort, right? And you're saving yourself a headache. But now you said something that makes so much sense to me, and a lot of people need to hear this again. When he's talking about the bid and the ask, ladies and gentlemen, is a spread. So when we trade SPY, it's usually $1 what? Spread, because SPY has a lot of what? Liquidity. Mm-hmm. Right? So that means millions and millions and millions and millions of dollars that get put into SPY trading back and forth on a daily basis. So that's why it's very important to understand what liquidity means, right? Because you don't want to get into a stock and it have the bid and the spread of $100. You already lost $100 when you got into the trade. As soon as
you buy in, you ready going to be down. You're going to be like, how I just buy the contract and I'm down 15% already? Because the spread was so wide on the bid and the ask. And you probably got it closer to the ask price.
There's no liquidity. So, ladies and gentlemen, make sure you understand why is no liquidity, and then we can rock and roll from there. Now, let's get it, ladies and gentlemen. I got a slide for you guys, and I want you guys to lock in. We're going to cover like 20 more slides. Me and Mike just want to make sure that we bring you guys quality information so you guys can take it back to yourself, for yourself, and also your family. Now, we're going to rock and roll. We're going to cover buying a stock, selling of a stock. We're going to cover a few things that's on the side of the slide. Let's rock and roll, Mike. First thing we want to talk about is the New York Stock Exchange and the NASDAQ. These are the two main components of American exchanges inside the United States of America, right? They both are headquartered in New York City. New York City is not just a mecca of basketball, ladies and gentlemen. It's the behemoth of what? Finance, right? Money, ladies and gentlemen. So if money is being poured into New York City, you always want to look at companies and investment opportunities towards what? New York City. Now, both of these are open Monday through Friday, 9:30 a.m. Eastern, and they close at 4 p.m. Eastern. Now, if you guys on the trading side of the spectrum, you guys are trading next day or weekly or monthly contracts, you can trade options on SPY, QQQ, IWM up to 4:15 p.m. Eastern. Now, we know that the market is going to be closed on holidays, ladies and gentlemen. We don't have to explain that to you. But now, I'm going to have Mike break this down to you guys, the New York Stock Exchange. Go for it, Mike.
So New York Stock Exchange is located right there on Wall Street. So this is probably the stock exchange you will see the most on TV when you have anchors talking. And it used to be a lot more activity going on at the New York Stock Exchange before we went all digital. You know, before we went all digital, this is where the stockbrokers would have to go in order to place and order, buy or sell orders in person, which is why at that time you almost needed a stockbroker. And that mindset, believe it or not, this just came to me. That mindset is the mindset a lot of our parents and grandparents had when it came to investing, which is why they really probably didn't pursue investing the way that we have the opportunity to now in present day. Because back then, it definitely did require much more of a process than you starting a Robinhood account. It wasn't so easy. You know, you actually had to put in some legwork and, you know, be calling your broker. You had to go to a brokerage to sign up. And that was a lot more legwork than we have to do now, which created that image, because you could have got in the stock market back then, but it created a certain barrier that a lot of people in the black community were not interested in having to overcome just to get into something that they didn't really understand in the first place when it came to the stock market. So that's the New York Stock Exchange right there. Like I said, so on Wall Street in New York, it's by far the most popular stock exchange in the world. A lot of people used to be here in physical and present, throwing up bid and ask tickets like back and forth at each other, cursing and screaming. You'll see it a lot in the movies when people have representations of the stock exchange. But now a lot of this has gone digital. You'll see a lot of people that trade. They're trading through apps now. So you have very few people and organizations that still go to the physical stock exchange unless you're doing, an IPO. You'll still see people do their IPOs on the stock exchange when they ring the bell and it's the first day the company's trading public. You'll have those kind of events happening. But outside of that, there's probably a certain group of people that go to the stock exchange every day, and they're probably very familiar with each other at this point because of how small that group and community is.
Which makes sense. And a prime example, ladies and gentlemen, I want you guys to think about this. Mike will agree with this. It's $30 trillion plus, right? Y'all follow me? The largest market cap, right? If it's $30 trillion that's put inside the market, ladies and gentlemen, do you guys think you guys want to take some of that money? Yes or no? Just a small percentage, right? So we have to start thinking from a larger point of view, but we got to be able to scale in and make small pieces of this what? How? So now, one of the most famous movies that showed the New York Stock Exchange trading floor is Trading Places.
Yes.
Right? Remember they was trading and they was trying to get reports, Mr. Beats and all that. So it showed that it was big, right? That's how crazy it was. Now it's done on a what?
On a phone.
Cell phone, right? Or a laptop or a computer, ladies and gentlemen. So my thing is we need to lock in and pay close attention. Now, the next one, this is one of my favorite, right? This is the NASDAQ. So this is tech heavy, ladies and gentlemen. Tech heavy is over 3,000 tech companies on the NASDAQ. So remember, if you're trading QQQ, NDX, and NASDAQ, NQ, this is what's moving the market, ladies and gentlemen, tech heavy. So we do have top holders inside here. The percentage have changed a little bit. We got Apple, Microsoft, Amazon, Meta, which is Facebook, Google, Tesla, Nvidia, and then we got PayPal and Adobe, right? And then we do got like AVGO and things like that that's thrown in there as well. So my thing is, these are tech-heavy companies. So NASDAQ, ladies and gentlemen, lock in on the NASDAQ. Now, the next one, I'm going to leave this to Mike because I think a lot of people never really pay close attention to this one.
Yeah, a lot of people don't pay attention to the Russell 2000. The Russell 2000 are pretty much small cap companies. The smallest, they are index of the 2,000, smallest 2,000 stocks in the Russell 3000 index. So you got some companies in it like Crocs, IntelliTherapeutics, some semiconductors. You have a wide variety of companies. They're just on a smaller market cap, so they trade within the Russell 2000. And the Russell 2000, you may not hear too much about it, and a lot of people stay away from it because it's a little bit more volatile than the other big exchanges like the NASDAQ or the Dow or the S&P 500. It tends to be a little more volatile because these are smaller companies. But what you also hear is that when the market is on an upswing or a downswing, the Russell usually is leading it or lags it. So if you look at the Russell and we're having a pullback already in the Russell, but the SPY maybe is not pulling back yet, it could be an early signal that there's some weakness coming in that's affecting the smaller companies that hasn't hit the big companies yet. And then the same thing in reverse. You'll see the big companies take off and have a push, and sometimes the Russells will still be lagging behind because the big companies maybe receive some benefit and are enacting that benefit quicker than the smaller companies. So the Russell 2000 will lag behind it. But those are pretty much your small companies.
And then one of the main companies that I like as a small cap is Crocs. We know that people love the way these shoes, Crocs, especially people that's working in the medical field and things like that. Now, comfortable shoes. So you do have quality companies that we can recognize that's inside the Russell 2000. Now, next thing, this is one of my favorite. This is the oldest what in the what world? This is the oldest what in America, right? Mm-hmm. Exchange, right? The Dow Jones, ladies and gentlemen, is only 30 companies. So I tell all new investors, if you study all 30 of these companies that's on the Dow Jones, you'll know which way the market is moving for today.
Yep.
Right? Because it's only 30 companies to focus on. It's not like the S&P 500 when it's 504 companies, right? You know they say S&P 500, but there's 4 extra companies inside of it. Now, lock in on the Dow Jones, ladies and gentlemen, and it'll take you to the upper room, ladies. Trust me. Lock in on the 30 companies inside the Dow Jones. Now, Let's talk about this. Me and Mike, we're gonna go back and forth on this because I know he feels some type of way about the S&P 500. I feel the same. Go for it,
Always.
Mike.
Always, man. S&P has given me some up days and some plenty of good days and also down days as well when I first started investing in the market or trading in the market. But the S&P 500 is pretty much going to be the top 500 traded companies are going to be revolving through the S&P 500, and their percentage of holding is going to vary based on their level of performance and what the people who manage the S&P 500 feel like they should increase or decrease the holding in that particular company. So you'll see like someone like Nvidia. Nvidia is one of those companies that kind of blasted its way up the rankings in the last few years, and now they're one of the top, like one of the top 5 holdings in the S&P and the Nasdaq. And the reason they're there is because of how fast their price appreciated. So they may have been a holding in the S&P 500, and the S&P, I'm pretty sure, did definitely increase their holdings there. But as a company increases in price, what happens is a lot of times, just like your portfolio, if a company starts to increase in price, it becomes a larger percentage of your portfolio. And sometimes you got to trim it by selling some off and diversifying into another company. But that's what the S&P 500 does for you. You don't have to worry about doing all that. They do all that management for you. And if you're somebody that doesn't want to have to worry about that, this is one of those exchanges that you can buy and hold. And like we were talking about, it's more so for long-term 3 to 5 year holds. And you go ahead and use this to borrow against the liquidity and get some liquidity that you could use to do other investments with.
Now, S&P 500 to me, it sounds like the boogeyman, right? It's everybody is afraid of him, right? It's like Freddy Krueger coming to your dreams. It's like Jason coming out of the pond, right? It's like Michael Myers coming from behind a tree. People are like, oh, I'm afraid, I'm afraid, I'm afraid. No, don't be afraid. It's the biggest boy on the block. So my whole thing is you got to stand up to him, right? Because you know that once you get through the S&P 500, the rest of the market is a cakewalk. So the top holders in the S&P 500 is always going to be major companies. We like Apple. We love Microsoft. We love Amazon. We like Facebook, which is Meta. We like Google. We like Tesla. But let's talk about Amazon for a second. We all have Amazon Prime. There's no way around it. Every American citizen pretty much have a subscription. They got something delivered for Amazon. So as we continue to keep on moving forward, these should be one of your companies that you think that will have a higher opportunity for a larger return over the next 5 to 10 years, because they not only inside delivery, they also inside the healthcare space, prescription space, food and beverage space. They in the car space. So my thing is they're going to be a part of everyday life that's got going on for you. So lock in on Amazon, ladies and gentlemen. Now, let's talk, Mike. You can cover the bearish market. I'll cover the bullish.
All right, bearish market is what a lot of people are worried that we're heading into right now with all this news coming out with DeepSeek and the tariff talk. So people are starting to feel a little bit bearish on the market. And a bearish market is simply a market that is on a downtrend. And it's doing a downtrend and it's held a downtrend for a specific amount of time. And once the price falls of an industry or a specific stock falls more than 20% from its most recent high, then you consider yourself entering a bear market at that point. So if you got a $100 company and it starts trading for underneath $80, that company has experienced a recession-like pullback. So that's a 20% pullback on that. So that's a guideline that everybody looks for in the stock market to identify a true recession versus one that is just being speculated, because you get a lot of speculated recessions, but they don't actually happen. You know, they don't actually end up being 20% pullbacks. So that is what a bearish market is. You want to keep an eye out for that. Remember, the 20% is what you want to look for. So when we're talking about the S&P 500, when you see the S&P 500, the Nasdaq, and the Dow, and they pull back by 20%, you know we're in a recession.
We're in a recession, so don't get this confused with a correction. Mm-hmm. A correction can be a 10% correction, right? We had that, right? But my whole thing is after that, the market took off. But if you see a 20% fall in the stock market, ladies and gentlemen, it's a bearish market. This is your opportunity to go fishing, right? Yeah. I'm not talking about go fishing in your pantry. I'm talking about the fish in the pond, right? You start willing in these quality companies out of what? Extreme cheap price. Because you know that over a long period of time, these quality companies will continue to keep on going to the what? Upside, because they have to what? Retrace, because the big banks like BlackRock, Vanguard, and State Street is going to do what? Buy more what? Shares, right? So if they buy more shares, they know that the stock is going to continue to keep on going over a longer period of time. Got it? Now, my favorite market is a bullish market, right? I like when things are green, right? Because when it's green, guess what that means for me? I can count some cheese, right? I try to tell people if it's green, I'm getting paid. So a bullish market is when the condition of the financial market, the prices are rising, right? And it's continuing to keep on rising over a long period of time. Even over a short period of time, we can have a bullish rally, right? We can have a bullish trend, but the S&P 500 has been bullish for the last 3 years. You guys notice that? The last almost 3 years, we've been bullish, right? So my thing is pay close attention to bullish markets and pay close attention to bearish market. Now, we're going to talk about the VIX index, right? Because if the market is up, that means the VIX is what? Down. These are inverse. Can anybody tell me why is the VIX index important to the stock market? Why is the VIX index important to the stock market? Can anybody explain this to me? Why? Right? Because my thing is, it's giving you news, right? It's giving you an understanding of where's the volatility, right? Because if the VIX is extremely high, that means the market is extremely what? Low. That means the market is taking a hit. So if the VIX is down, that means the market is up. So we want to pay close attention. So here goes some tickers that you can trade. SPXU, UVXY, VXX, VIXY. You can trade these when the market is going up or when the market is going down, but this is what technicals come into play. Got it? Now, let's talk about this, Mike. How do you feel about the investor sentiment wheel? We all have felt this way before.
Oh, yeah. I mean, this is the range of emotions you go through as an investor. It's just, this is why they have things like the Fear and Greed Index. You can find that on the CNBC website. They measure in the fear and greed of the whole entire market. So I don't know. They're doing surveys. They're getting the temperature of how the average investor feels out there about the market at the time. And we all go through these phases. When you hit that 200, 300, 1,000% trade, you go into euphoria. You just like, I can't lose at this point. You start feeling invincible in the stock market. You start feeling like everything that you put your hands on or every trade you touch is going green for you. And that's when you're in that stage of euphoria, And then you are at the opposite of that, and it's fear, which is when you start feeling like, damn, I just took a 30%, 40% loss on the trade, or I just got washed out of a trade, I got stopped out, and now I don't know where the next opportunity is, and you start having so much fear that you blind yourself to all opportunities that are coming up in the market. And now you're so scared that you're not putting your money anywhere. So you have those two opposite sides of the spectrum. And then, of course, you got everything in between as far as all the emotions. People know you feel agony, anger, optimism, you feel all these things when trading, because I think trading is a very spiritual thing. As I try to tell people, trading is going to take you through a deep journey of self-discovery. And you're going to feel a lot of different emotions and have to do a lot of self-reflecting in your investing. But once you get a strategy down and you got that consistency, you're going to feel confidence come back into yourself. Not just in investing. You might start feeling more confident in your general life because now you're executing something efficiently. And even though it's just maybe in the stock market, you'll start carrying that over into other parts of your life.
That makes sense. And when I look at this wheel, ladies and gentlemen, I see me. All right. I've been in this phase. I've been in all of these sentiments in one day before. I've traded SPX. I said, oh my God, agony. I was depressed. I'm getting killed, right? And I felt uncertain. Then I was optimistic that, hey, the stock is turning around. And I felt euphoria. Wow, did that just pay off? So in one day, you can feel all these emotions, right? Because we are traders and we are human beings, right? We do have an attachment to money, right? So these things can happen. So my thing is understand what phase and how you feel for the day. But if you start the day off and you're not in any trade and you feel agony already and depressed, don't trade, right? Because you're not in your right space, right? In your right headspace, right? If you get the trade not in your right headspace, you're going to lose. Now, we got fear and greed. Mike just talked about fear and greed, right? So this basically is managing the fear in the market and the greed in the market. But we're going to keep it real with you guys. I want to buy the fear and I want to sell the greed. So I want to buy when nobody else wants it, right? Everybody, the market is going down. Guess what? Okay, I'm going in, right? Because my whole thing is these are quality prices to me, and I want to take advantage when you get back in the market because now you're greedy, and I'm going to sell at the top while you buying at the top.
Yep.
So can anybody tell me a famous investor that's sitting over $180 billion in cash? Can anybody tell me what is the famous investor? All right, and we're going to explain to you why fear and greed is very important. Warren Buffett, yes, right? So think about this. Warren Buffett is allowing everybody to buy the greed, right? And when the market falls, he's going to deploy his cash because he's going to buy the what? Fear, and he's going to entice other hedge fund investors to buy in, and guess what's going to happen? He's going to sell out the what? Greed. So now he done made a healthy return because he bought the fear when nobody what? Wanted it. So fear and greed, you can measure every day, ladies and gentlemen, fear and greed. You can type it in, fear and greed of the market. When it's extremely greedy, ladies and gentlemen, stay away from the market, right? But when it's extremely fearful, look for opportunities to buy. What you say, Mike?
I say that's a psychology that the market plays, a psychological game the market plays with people a lot of the times as well, because when the market is in greed or trending towards greed, that's when the market conditions look the best. So it's like, this is the time that you're going to feel like you're more enticed to invest. You want to buy more contracts now because the market's on the up rally. You're like, oh man, then you start getting FOMO, fear of missing out of the next rally. You don't want to miss out on that next big jump the market takes. So you're buying into greed now instead of waiting for that pullback and buying when everybody else has a sentiment of selling and everybody is scared of what's going on. A perfect time would have been COVID. COVID was a time where a whole bunch of stocks dropped sharply for about 30 days before they started coming in with that stimulus news. When they started coming in with the heavy stimulus news and how they were going to stimulate the economy with those checks and everything, before that happened, the market was on a sharp downturn. And that was the opportunity to buy. But everybody was in fear. Nobody knew what was going to happen. Everybody was worried about this disease breaking out all around the world. So people's minds were so far gone. Or when we have something like a war breakout, or we have any kind of trauma event that shocks the market, or like a recession that's happening, those are the times that you want to look to be buying the most.
Right, because now this is actually putting you at an advantage over your competitors, right, when it comes to competing, right? Because remember, we are competing in the market. We compete. Yeah. We're competing to get the best price, right? We're competing against the big behemoths, BlackRock, Vanguard, and State Street, Chase Bank, Berkshire Hathaway, competing against these trillions and trillions of dollars of companies and these tycoons, no matter if it's a male or a female. So you want to get the best price possible because you want to get a higher return over the next year, 2 years, 3 years, 5 years, and 10 years, and so on and so on. Now, let's talk about this. We got a few more slides, and we're going to open it up for questions. We do got Fear and Greed Index. It's based off of stock price momentum, stock price strength. We got put and call ratio. That's very important. We're going to dive in there, but I want to go ahead and talk about what are you? You are a retail investor, ladies and gentlemen. You are not a professional. You are retail investors, right? In order for you to be a professional, you got to take your serious what? What you got to take? Your serious what? Come on now. Nobody knows? Mike, tell me what you got to take.
Series 7.
All right, and what else? What other series do we have? Come on now. Talk about it.
Got the Series 65, Series 7, Series 6. So there's a few different licenses that you could get out there that'll give you that more of a professional status outside of a retail investor. You know, so there's certain things in each license. Each one gives you a right to do different things. One gives you a right to manage other people's money, while some only give you a right to advise. Like the license I got, Series 65, only gives me the right to advise people. You know, I can't take your money and manage it, invest it in the market for you. But someone who has a Series 7 can do that. You know why? Because that's the training and education that they received underneath that license. And honestly, people like that are people that work usually with banks and firms that usually take in people's money, and that's what they're trying to get you to do all day. Just give me your money. Don't worry about it. Give us the money, and we'll give you this 3-4% return annually. You don't have to worry about taking any losses. We'll just make sure your account continues to grow 4.5-5% a year. Meanwhile, they're making that 10-12% on your money and giving you 4%. You know, that's what a lot of people who have those licenses do, and institutions that have people who work for them have those licenses do.
And that makes sense, ladies and gentlemen. So as a retail investor, don't think that you might be better investor and trader than professional investors, right? Yeah. Because my whole thing is they can be too headstrong in one direction. They're not able to pivot because they're managing hundreds of millions and billions of dollars. And by law, they have to actually tell the SEC when they are buying and when they are selling shares and votes, right? And when they are selling shares and votes, you don't have to do that, ladies and gentlemen, because we operate on a macro scale. Compared to the scale that they're operating on. So be happy as a retail investor, because at the end of the day, you have an opportunity to continue to keep on spending. I would tell you this, for it to be very beneficial to you, it's okay to actually take your Series 7 and things like that, because at the end of the day, it will benefit you later on in life and then actually help you manage your family and your self investments and things like that. Now, outside of retail investors, ladies and gentlemen, who are you as an investor? We need to know who we're participating against. This is financial market participation. Who are participating in the market? Retail investors and what? Retail investors and what? Institutions.
That's it.
All right. We are competing against BlackRock, Vanguard, and State Street. So inside my group, when I say, hey, see something, say something, basically what I'm trying to tell you is don't eat by yourself.
Right. That's what I tell people in the group all the time. Like, we're in a community for this. Like, I'm not in a community to try to be the head of everything and I have all the best call outs. And no, it's not about that. I no pride or ego involved in this. We want to teach you because we understand the positions that we are in as well. We are retail investors in the sense that we want to now empower the retail investors around us. So now we have a stream of information and news coming in similar to that how institutionals get it because they have a whole team working with them. So we just want to develop a team and we got to work together and bring each other's information. No, don't think about any company that you could bring that is possibly, oh, this is a stupid investment. Let me not bring it to the group. Bring it to the group. Let us analyze it and give you feedback onto, okay, we think this is good or no, we're not going to pursue this one.
Right. So think about how many opportunities I missed when somebody said, hey, I saw this, right, but I didn't say anything. Or they say, I saw this, I took this trade individually, but I'm going to tell you that I made $3,000 off a $100 investment. No. At that point, ladies and gentlemen, you shouldn't be a part of a team. You should be an individual retail investor because you have to be willing to share the ideas, right? And you have to be willing to actually give somebody else an opportunity to get in on this idea, right? So see something, say something, because at the end of the day, what you might see, you might not understand. Mike might understand something that I don't understand, and vice versa. I might understand that something he don't understand. So guess what? We're going to trade ideas back and forth. Because we was on the line the other day, Mike said, I see QQQ going to this level. I'm like, wow, I'm stuck on SPY and IWM. But guess what? Other people was able to take the QQQ trade and they made what? Money.
That's it.
Right? So if I was just trading by myself that day, they would have missed QQQ, but they still would have hit on IW and SPY. But QQQ actually dropped at a faster rate than both of those ETFs.
Yep.
So see something, say something. And then my thing is recognize where your weakness at. And then my thing is try to build on your weakness. And our weakness as individuals, we are one person.
That's it.
So that's why we want to be surrounded by a community that's educated. So if you see something, Chris, if you see something, JD, if you see something, Brandon, if you see something, Jenny, all you have to do is say, Coach, I see this. Mike, we see this. And guess what? We're like, wow, I like that. That's a perfect setup. Right. And we all can take this trade and take advantage of it.
Right.
All right, now, we got like 3 more slides. Ladies and gentlemen. I want to talk about gold. Gold just hit an all-time high. Wow. We know that gold has been a standard for thousands and thousands of years. The richest man in history before Elon Musk just surpassed him was Mansa Musa, right? He used to collect gold and he did a pilgrim, right? And he deflated gold and all the Europeans and the rest of the world was like, wow, who is this man? We need to understand, what do he have? This is a shiny piece of nugget. So then that's why gold is very, very popular and why gold is very, very famous. Now, we got 2 forms of gold, ladies and gentlemen. I want you guys to lock in and listen to what I'm about to tell you. On the stock market, you physically don't own gold, right? You own paper, a paper note that the gold is increasing in volume by the ounce. Now, you take the paper gold, right, profits from the market, and then you buy the physical gold, so now you can hold on to wealth for the rest of your what? Life. So it's 2 forms of gold, paper and physical gold, right? You know that physical gold is not an anomaly, right? They found it all across the world, but guess what? He who holds the gold, he who controls the world. Have you guys understand that multiple countries like China, America, Europe, they hoard what? Gold.
Yep.
Right? And there's a reason why they hoard the gold, ladies and gentlemen, because gold holds its what? Volume, right? It's a precious metal that's used in multiple things throughout the world, right? And probably throughout through the universe, right? It's used in spacecraft, right? It's used in aircraft, right? It's used in rockets. It's used inside multiple other machines that we don't even know anything about. So buy the paper gold, get the gains, buy the physical gold. My thing is to keep wealth for the rest of your life. Now, stock. We got 3 more slides. A stock, when we talk about it, is an individual share. It gives you ownership of a company, right? No matter how many shares you got, ladies and gentlemen, you are an owner of this company. So if you got 1 share of Apple and I got 1 million, I might make more money, but we both are still individual owners of this what?
Company.
Mm-hmm. Right? So we are investors. We have a percentage and the ownership of this company. It doesn't matter. Don't let nobody tell you that your 1 share doesn't mean anything or your fraction of your share don't mean anything. You're moving in the right direction. You have ownership, and ownership is key, not just here in America, but abroad globally, right? He who owns things, he who controls things. Now, Mike gonna break down to you guys what an ETF is.
Yeah, the ETF is, like I said, I was talking about these earlier, the SPY, the Dow Jones, NASDAQ. These are different ETFs that hold a collection of stocks. So they're going to hold a collection or concentrated industry of stocks, whether it be tech, whether it be diversified, whether it be healthcare related. ETF, there's an ETF for everything. And these ETFs, like I told you, they are managed by whatever brokerage put them out. So you always want to look at who put out the ETF, how long it's been out, check its track record, because just because it's an ETF doesn't mean it's always been on an upward trajectory like SPY and NASDAQ and Dow. There's ETFs out there that have been very, very terrible ETFs because of the companies that are tied into them. So you always want to check out what stocks are tied into ETF. And this range of things we're talking about right here, ETF, stocks, and gold, this all goes back into diversity. So these are the things you want to think about when you talk about diversifying. Think about, okay, do I have an ETF? Do I own a stock? Do I own a precious metal? Think about that. Do I own crypto? Do I own land? It's not all about just diversifying within the stock market. It's about diversifying your investments in general.
That's a fact. And I think diversification is one of the quality things that we all should try to implement in our life, right? Owning some gold, owning some crypto, owning some stocks, owning some real estate, right? And just owning things that actually going to bring you volume and a peace of mind, right? Even owning water rights, right? And this is what people's owning now. They own their water rights. Now, we're going to leave it out here. When you guys are investing, ladies and gentlemen, you're buying a stock on a platform, right? It's multiple platforms. I'm going to yell out a few that I like. E-Trade, Webull, Robinhood, we got Thinkorswim, which is under the umbrella right now. I want you guys to think about this. You got multiple other brokers that you can buy from. You got Fidelity, right? But my thing, it doesn't matter what brokerage you buy from, ladies and gentlemen, make sure that you open up a brokerage account so you can actually own some long term. I'm going to say peace to everybody on YouTube, but we're going to continue this meet inside here. And then we're going to talk a little, we're going to open it up for questions. All right, ladies and gentlemen, we open for questions, ladies and gentlemen. Me and Mike, we open up for questions. You guys got literally 8 minutes. Let's rock and roll.
Let's do it.
8 minutes for questions. All right, fire your way, ladies and gentlemen. No such thing as a stupid question. Ask your question, and my thing is we'll put ourselves in best position to be able to answer it. Let's go.
So y'all touched on long-term stocks and also short-term, but what about dividends?
So there's going to be a whole other class, but dividends is very important. I did give a list of dividends that I really like. If you do going to invest in dividends, turn on the drip. So you want to reinvest those dividends to actually buy you more percentage in that stock so you continue to keep on making money. That's where the money is made. So Warren Buffett makes $700 million a year off of Coca-Cola dividend.
Right. So dividends, right. Yeah, we was going to be talking about dividends. Dividends in themselves ties into a lot of what we were talking about earlier with compounding and how to compound your investments. That's a lot of that is done through dividend investing. And there are strong dividend companies out there. You got dividends that pay quarterly. You got dividends that pay annually. You got dividends that pay monthly. So there's people that are setting their portfolio up to receive monthly income from their dividends, and they survive off that dividend payment monthly. So they'll get enough shares in the company where their dividend payment is going to give them, let's say they need $5,000 a month to survive and pay their bills and et cetera, et cetera. So they'll buy enough shares of the company that pays monthly dividends so they could get $5,000 a month in dividends. And meanwhile, your money is still sitting in this company, and you could have the company potentially grow. So now if you pick a good long-term dividend company, your asset, that the money that you invested is growing, and along with that dividend payment you're getting monthly, it goes from $5,000. If they increase the dividend, next thing you know it's $5,200. Next thing you know it's $5,500 a month, and that's all depends on the strength of the dividend company you invested in.
All right, that makes sense.
And the time factor. So, like I said, you want to look at it. If you're looking at dividends for income, then you might be looking at monthly. If you're looking at dividends just for compounding and growing, then maybe a quarterly would be good enough for you. But you want to look at the dividend percentage. You want to look at the amount and make sure that the math makes sense for you. So for every share you get $1 in dividends, that's easy math for you. So 100 shares gets me $100 in dividend payments. Then you could just do the math for how many shares do I need to get in order to get $1,000 in dividend payments, or whatever your goal and target is. Because dividends, that's one of my favorite things. I love dividends, boy.
And you want to look at aristocrats. You want to make sure that you're investing into a company that continue to keep on rising their dividends or keeping their dividends. You don't want to get into a company that had dividends for 5 years, cut it for 3 years.
Yeah.
No. I don't want to put my money into you because guess what? you all discombobulated, right?
Yeah.
Now you are letting me know that you're a company that I do not want to invest in because guess what? You're not managing the company properly to be able to disperse dividends to me. So I like dividends. Now Apple does pay small dividends, ladies and gentlemen. Now they just incorporated about a couple of years ago now. But it's so many quality companies. But I would tell you guys to keep it simple. You guys drink a lot of products from Coca-Cola. That's a great dividends paying company. It's great. Because my whole thing is when you look at the totality of the stock market, if somebody's going to pay me in a dividend and I still make money while the company goes up in volume, I'm getting paid twice. Why would I not want to get free money?
Right.
So I try to explain to people, get the free money, right? Because at the end of the day, the money is not going to last forever because at the end of the day, let's say Coca-Cola say, you know what? 40 years when Warren Buffett died, let's say Coca-Cola say, you know what? We want to cut our dividends because we was keeping it low because Warren Buffett did a major investment, right? So my thing is, that's what we want to look at. So dividends, Coca-Cola does have earnings over the next 9 days. So they do have a market cap of $273 billion. So my thing is, they can afford, they do have a dividends of 3.09%. So they pay you 48 cents per share that you have.
So
that's
now,
a great dividend.
That's a good dividend. And for people who are looking for dividends to be income producing for them, you may look into high yield dividends. Because like I said, for people who want to invest, there's going to be something for you. I always wanted people to tell me what you're interested in first, and then we could find the investment tools and things to navigate you to. Because there's a standard where everybody could just say S&P 500, NASDAQ, and those things will grow. And yes, you will make money in those growing, but that may not be reaching the goal of what you want. That may not be aggressive enough. That may not be giving you the dividends you're looking for. So everybody's strategy has to be different. For high yield dividends, there's some people that want to be able to live off their dividends. So you'll go for a high yield strategy. And there's literally high yield dividend strategies out there. I was talking about some with my Discord last week. They got the high yield strategies. I got them up here. Hold on, let me I can share my screen real quick. Let me see.
Go for it. Just knock me out. Because I'm going to show them where they can go get into startup.
All right. Let me share my screen real quick.
Knock them out. Take notes, ladies and gentlemen. Take notes. Teamwork makes the dream work.
All right, there we go.
All right, here we go.
All right, so
what platform is this for the people that's new?
So this is TradingView. So I use TradingView to do a lot of my charting and level setting on stuff. So this is just on this is a Coinbase one. This is called Coney, CONY. If you look in the top left, you'll see this is a title ETF trust Yield Max. This Yield Max has been coming out with a lot of different high dividend yields for even companies that we like to trade. We talked about earlier, Amazon. They got one for Amazon, right? So let's open it up. Let's go and see how much they're paying for Amazon dividends. We have Amazon, and let's see what their dividend payment is for Amazon. Let me see. Is it on this page? Yeah, it is. No, it's on the next page. So when you go down to analysis, one, you want to look at it says the X date, record date. So you want to look at how often does this occur? Is this a monthly? Is this every 3 months? So this right here, this shows you that this is monthly. Except it shows from July. It could go all the way back and show more. Every month, back to September 2023, they've been paying dividends. And you want to trace back and make sure, like Cardar was saying, there's no gaps in the dividend payments. They didn't stop at any point. You want to see consistency, whether it be quarterly or monthly or annually, however frequently they pay. But now you look at this and say, all right, this is Amazon, right? And I could get this AMZY for $19.80 a share. But for every share I'm getting, you see, but this is where this strategy fluctuates differently because this is not consistent dividends. You see they change the amount. It'll go 40 cents one month, 80 cents the next, $1.17 the month before that. This all depends on where the stock is trading at that time. So
Mike,
when you do it,
I want to hit on something. I don't mean to cut you off.
No, you go ahead.
Go to the dollar and some change and leave your mouse there. Y'all you put the shares is $19, right? you literally get $1 and what?
$1.17.
So think about if you got $10,000. How many shares can you buy at $19? How many shares can you buy, y'all?
Yeah, run the math, run the calculators, bring the calculators out.
Come on, how many shares can you buy? I'm waiting. I want to hear his answer. You got $10,000, right?
Like 520, 530.
Yep, right
So
around there.
So guess how much money you just made? Times that times $1.17. You just made $615 off the dividend. Let's say they do this consecutively for 10 months. You just made 60% return in
On your
10
money.
months on your money.
Just dividends. And that's the money could still be in there. This shit could go up to $25 at 1 month, from 19. It doesn't have to stay around 19. So let's look at the chart. But
I
yes,
like that.
that's the power right there. And these are monthly. So like I said, these is called high yield. And you can find them for almost any company. They got it for, I was looking at for Airbnb. But the ones I like the most was Coinbase. Because of how it's tied to crypto, and the crypto industry, I think, has a lot of room for growth. And just the Coney.
Before you can go back, Mike, I want to show you something.
No, go ahead. Let me see.
So you can share. Click back on there.
Mm-hmm.
All right, click at the top. Share that list.
I got you.
Yeah,
Well, I got to go right here.
It's going over. Keep going. I think it right there. I forget which one it is. The share it.
Symbol. Let me see. Where is it?
Yeah. Share and go to the dividends one. Go right there. Go. All right, now go to it should be in there.
Share list. Oh, here we go.
All right, go to copy it.
Yeah, all right. I'm gonna paste this right into the chat right
so
now.
they can have it.
Yep.
So now he just gave y'all $1 million worth of game, free on the house.
Free on the house right there. Whole watch list for you to go check out on some dividend yields. Yeah, there we go. There we go. I like that. Okay, I didn't even know you could do that. All right, shit. Let's start sharing some watch lists in here. Let's make that happen.
And then guess what they do? They just click on it and upload to their trading view.
Oh, beautiful, beautiful. Okay, so yeah, you guys got this whole watch list right here. I got a lot of the yield maxes on this list already. I say go do your chart work on them. Like I always would do chart work on anything, which is why I even have price levels on this Coney one. As you see, I'm finding Coney support right here. I want to buy a lot of this Coney yield max right down here because if you look at Coney, let me show you what they're paying. So you got $13 right now cost, right? So let's go look at theirs really quick. At $13, and you could be getting off of your $13, they're paying almost $1. They've been paying consistently almost $1 for every month. Look at this, going all the way back to October 2023, $1.20. At one point, they was paying $2.60 for every share you have. And this thing, that's what I was telling people, like right here, this is how you could play Coinbase for income. But if you want to see Coinbase for growth in your portfolio, I've been telling people do a 70-30 split. You do 70% in the stock, 30% into this yield max. And you'll have the income coming in from the yield max, and then you'll still get the growth from the company. Because Coinbase has very much outperformed this as a company on the stock chart. But as far as dividend payments, you're not getting any dividend payments from Coinbase. You understand? Right. So you're not going to get the dividend payments with the growth. But if you want the dividend and the growth, buy the stock and then buy the yield max for the dividend.
And now you make the money both ways.
That's it.
That's part of the game. I think they're not going to teach you this information because they don't want you to get ahead, right? Because once you get ahead, you stay ahead because now you have the game. You can't unlearn this, right? So once you learn it, you can't unlearn it. Now, we're going to hit y'all with a site that I think everybody should invest in, and then we're going to let you guys enjoy the rest of your day. All right? So you guys can see on my screen, I got something that's called Startup Engine. Let me know if you guys see that, Startup Engine. All right? Let me know if you guys can see it. Y'all can see it?
Yeah.
All right, so Startup Engine is a site, ladies and gentlemen, where you can actually buy startup companies ahead of time. You just make a quality investment. So now I like Boxer, ladies and gentlemen. This is one of my favorite. I'm going to give you guys the game. If you guys don't want to pay $400,000, $500,000, $380,000 for a house, Boxer is the future where you can get a prefab house, 2, 3 bedroom, 4 bedroom. You can get a 2-story, 1-story. They just come and hook it up on your land.
I love Boxable. Wait, put this link up ASAP. I need this link right now.
Yeah. Because it's like, this is the future because I think a lot of people are dropping the ball on it. It's right now, the minimum investment is $1,000. It was $500.
Oh, man.
So guess how much they just raised? Look at this. They just raised over $5 million again. Their valuation is $3.5 billion. Yeah. This is not even public. Yeah. So watch when it goes public, ladies and gentlemen. You're going to have a hella investment on your hand. I just put it inside the chat. So take advantage of this. They got other things, and I know y'all know who this guy is, right? Don't let me know y'all don't know who this guy is. I call him Cricket.com. He Can anybody tell me what is his name? Anybody?
Kevin O'Leary.
Kevin
Right, so
O'Leary.
my whole thing is, this is him. Y'all, do y'all want to make money with him, or do y'all want to make money at no money at all? This is the game.
Yep.
So if you look on here, it gives you quality investment. Right? Boxels, precise agriculture. Now, this is shocking to me that nobody wants to invest in this, right? Nobody wants to invest $300. As we move forward in the future, it's not going to be no human beings out playing agriculture. It's going to be all robotics.
Wow,
So
I
why
like
would you
this.
not
I
wanna
really
take
like
advantage?
this. This is a gem right here. Listen, man, the stuff y'all getting here for free, boy. I swear, this is heavy gems
Take
right here.
advantage. Right? They're going to charge you $1,000. We're not trying to do all that, ladies and gentlemen. We're just trying to make sure that you guys got quality information for the free. Right? And if you guys join my team or my team, it doesn't matter. Because
Yeah.
at the end of the day, we still going to continue to keep on delivering day in, day out, because this is what we enjoy and this is what we like. Now, there's another one on here I want to show you guys.
Hey,
Let me
another
see,
thing with
man.
Boxable too. I don't know if people saw a year ago, 2 years ago, how Elon Musk doesn't own a house. Elon Musk travels around and he gets Boxables delivered to his location so he could sit there and live wherever he's at. If Elon is already
Right.
somebody who's using Boxable very, very frequently, then that lets you know where this could potentially go in the Trump presidency.
All right? And this is crazy because the United States government have contracts. I think the military bases is building up makeshift bases in the middle of the desert. That they're going to be there for a year or 2 or 3 years. Now, this is my next favorite. Anybody on here ever seen a 3D printer? They can 3D print your
Yes.
house in 2 days.
Nice, nice. See, I'm gonna be investing. I'm gonna be digging onto this site heavy, boy.
So look at the video. I don't know if it's going to let you guys hear the sound, but let's lock in. All right, just look at it, lock in. They come to the site and they build you up. Here we go.
Look at technology. Look at this.
Just giving you guys a game. You don't need nothing. I can build a house in 2 days with just this equipment.
Hmm.
And they taking 6 months to build your house. They charge you $10,000 extra.
Hey.
Extra a day.
I would not be surprised if after the California fires, you see something like this rolled out in California now to help rebuild those neighborhoods rapidly.
I got it in my notes.
Nah.
I got it in my notes. Well, Chris, you on here? He went to school with me, went to high school together. Chris, this was the idea in Gary, Indiana. Buy a whole block, right?
Yep.
Demolish the old home, have them come 3D print you 6 houses for under $300,000.
Right there. Yes. Yes.
Right.
You get what I'm saying? This is the idea. This is why I try to bring it to people, right? Because think about it. It's going to cost you $50,000 a house.
Yeah.
For them to build it, for you to furnish it and do everything. Look how fast they just 3D built these houses. They building communities.
Now, that's the thing I was gonna say next. Building communities, man.
That's a good idea for Detroit too.
Yes.
Detroit already been doing it.
For all black communities, we need to start implementing something like this.
This is the game. I'm giving you guys the game within the game. You don't have to pay me for this. This is a free site, but a lot of people don't know nothing about it.
Yep.
So I want to bring this information to you guys because after that, people online, they're going to charge you all of this money. We're not doing all that crazy shit, bro. We want y'all to get this money. Now, one of my favorite companies, I'm going to give you guys this long term, right? I'm going to pull this up, and I want you guys to lock in on this long term. It's called NNOX. All right, this is an X-ray imaging, right? For all X-rays, MRIs, all of this, right? Guess what happened on a 12-month time frame? Y'all tell me, y'all look at the spike. Guess what happened when it spiked? Multiple times. They found that in the video, which was supplying the chips in the video, was invested in this company. I've been had it. I went to X-ray school. I've been talking about this company since 2020, 21.
Wow, nice.
So please buy it. So this is what they have. Anybody know anything about X-rays? It's heated anodes, right? So this company said, guess what? We're going to go to cool anodes. So we're going to be able to cool the tube a little bit what? Faster, right? So your tube is not damaged. So guess what? You can actually expand the life of this tube, but we're going to charge you a higher what? Premium.
Right.
Right? So as they charge a higher premium, watch this, ladies and gentlemen, watch these products. Can anybody tell, what do you think they sell? Anybody? Look at the machine. All you have to do, Mike, I can put this in a facility in the middle of the desert, the machine, and it can have keyless entry. I can take an x-ray from my house in London. Why, I just tell you to sit on the table.
Ah, okay. Wow, look at that. Look at that.
Yeah.
And that's coming from inside, for someone who worked inside the industry. That's more information I like. Anybody that's been hands-on in the industry and they come out and say, oh, this is going to be big, I always listen to those people because they're the ones on the ground every day dealing with this stuff. So if he's saying this and he's dealing with x-ray licensing, like, come on now. This is inside information almost.
And this is what makes it even perfect, is lower radiation dose, right? Because guess what? The way the machines and the anodes are set up, the patient is not receiving that high doses of radiation. So guess what? It's eliminating the possibility of you developing cancer over a longer period of what? Time. Now, I want you guys to look at this video. I want you guys to really think about what I'm trying to tell you. I went to school. I graduated for x-ray. Listen to what I'm trying to tell y'all. I graduated. I got a degree. So watch this. All right? They don't want to play the video. But my whole thing is, let's see if they can take us to YouTube.
It's going to be big for the doctors as well because that lowering the radiation, because my mom worked in cardiovascular, so the lowering of radiation in the room is good for the doctors so they don't get that same exposure because they got to come into the room and deal with around these machines. So if they could lower that exposure, that's going to be good all around for the patients, for the doctors, for everybody that works around that.
Guess what this means? It's going to be less energy, so electricity bills and light bills is going to be pretty what?
Right.
Cheap. So now the hospital is saving.
Yeah.
Right? So this is, and I want you guys to look it up. So they take efficient x-rays. Now, if you guys understand what kind of x-ray this is an x-ray, let's go back. Because I'm going to keep doing the same thing over and over. Now, my main thing is when we take an x-ray, we want quality.
Right.
You got that? This is quality, and this is what this machine offers quality, right? So let's go look at the specs and we out of here. All right? I'll pull up the specs. All right? And then I want you guys to understand that in the future, you're going to be able to take x-rays on iPads. People thought I was lying. They was capping. Society is changing fast.
I don't doubt it. I see Apple getting into healthcare. Apple's going to push into healthcare and fade out the phone industry sooner than later. Watch.
Here we go. Remember I told you guys about the tube?
Yeah.
Remember, it's filaments, right? Heated filaments up to 2,000 Celsius, right? It requires special tooling. So guess what they did? They said, hey, we're going to put new silicone chips. And who's going to be providing the chips? NVIDIA. Y'all following the game?
Yeah.
NVIDIA. So why would NVIDIA not invest in a company that's going to use their what?
Their chips. Yeah.
Y'all following that? If you go down, you say, wow, what's the benefit? Size improvement? What I just tell you? Energy efficient, right? Multiple sources of images. Y'all got that? I'm giving you guys the game. And then guess what? Everything is cloud-based. So guess what? We don't have to run wires for x-rays no anymore. Guess what? Everything is sent over to what? The air.
Yeah. What's the ticker symbol for this?
NNOX.
NNOX. All right. We adding that to the watch list right now.
It's HIPAA graded. It's 24-hour customer service, remote installation capability. Y'all understand what I'm trying to get you guys to understand here? This is the game. This is game changer. Now, when I went down the list and I noticed something, it uses artificial intelligence and deep learning. So guess what? The machine learns the patient as the patient continues to keep on coming back. And notice, you didn't have this air pocket in your stomach, right? What is going on? You didn't have this gas last time. The machine notified the doctors, hey, the radiologist, something is different. We took a chest x-ray last time. His lung capacity is not the same this time. So guess what? Now they can go what? Dig deeper, right? Because the AI and deep learning is actually evolving. So get into this, ladies and gentlemen. Get into this. Is multiple modalities. Basically what this means, you can take x-rays, CT, MRIs, and mammograms and things like that. Right?
Gems on gems today, man. Gems on gems.
Y'all enjoy the rest of y'all weekend.
Yes.
The rest of y'all Sunday. We appreciate Mike. We appreciate everybody from joining. You guys can rewatch it on YouTube, but this portion of it is not on YouTube. Because my whole thing is we gave away a lot of free game on YouTube. I just wanted to give it to the people that are locked in outside Google Meet. Now, one thing I tell you guys, the market is going to be very volatile tomorrow, even when the futures market open today. But I'm going to tell you guys